Hello, everybody, and welcome to another episode of Fridays with Yield App. It's been a little while. We've saved the best until now. Today, we are talking all about securitized tokens. What are they? How big could they be? What kind of difference are they going to make? Should you buy some? We're not financial advisors. That's always down to you. I am Rebecca Jones. I'm the head of communications here at Yield App, and today I am joined by Josh Du from NASDEX. Say hi, Josh.
Hey guys, thanks Rebecca for having me. So I'm the co-founder of NASDEX. I'm really excited to be here and talk about tokenized assets.
It is a pleasure to have you. And we have Graham Moore from Polymath. Hi, Graham.
Hi, everybody.
Really great to have you both on. So first of all, can one of you, both of you, tell me what are securitized tokens? Maybe let's start with you, Graham.
Yeah, so from my point of view, a securitized token, I call them security tokens myself, just any financial security that lives on a blockchain. So these could be stocks, bonds, derivatives, whatever the case may be, some type of investment contract that self-identifies in some sense as being a financial security. So it's not a utility token thing or a cryptocurrency thing that identifies as something else, as a payment token or currency or something that lives in a third box. It's an actual regulated financial asset that lives in terms of its underpinnings as being a blockchain.
Okay, Josh?
Yeah, I mean, I completely agree with Graham, and I would say that I would go even further to talk about, potentially assets that's not regulated, to be included in the assets that could be tokenized and could be traded on the blockchain. So, like Graham mentioned, equities, bonds, real estate, but we could go even more with this. Balaji just mentioned that time could be tokenized, right? Some college student to pay off his loans could tokenize, say, 6 months of his summertime to work for someone who is willing to buy his token, and that token could essentially be traded on the blockchain permissionlessly, with immutability. So in terms of thinking about assets that could be tokenized, I think there's a lot of creativity that we can think about. Of course, all traditional assets, but there's a lot of assets that we probably haven't even thought about. And for me, the company I'm working on, NASDEX, we're just diving into the first layer of it, which is tokenizing equities. It's very easy. People understand it, and when people see it as a financial instrument, it is something that people are familiar with in terms of trading and analyzing it. So yeah, I mean, so that's my answer. But I think tokenization of assets could be much, much more than just the normal traditional assets that we're familiar with.
So the tokenization of equities, just so I think I understand what that means, effectively you're taking shares that are traded on the stock market, so maybe like Apple, Microsoft, Amazon, and then you're turning those shares somehow into tokens that can then be traded through an exchange like NASDEX.
Yes, that's right. So there's generally, in terms of tokenizing equities, there's generally two ways that people have done it in the market. One way is that the blockchain company or the protocol, they will physically buy the shares in the real world, and then they will offer it to their customer base on the blockchain using a direct swap contract, so that the users on the blockchain will gain the economics to the shares, which the blockchain protocol they have. So that's one way, but it's actually quite messy, and regulatory wise, it's very murky. The second way, which we're doing, is that we're simply minting these tokens, these tokenized equities on the blockchain. And how we're doing it is essentially the same way that MakerDAO DAI mints stable coins. We're using a over collateralized debt position, let's say 150% of a stable coin, and then with that we'll mint a tokenized equity, let's say 100% of it. And this tokenized equity, whatever it may be, Tencent, Apple, Toyota, the price of that token on the blockchain will be pegged to the price of the real live asset using an oracle. So 24/7, it's perfectly pegged, and then the collateral behind the position is to ensure that the peg stays intact. So, this is a decentralized way of tokenizing any sort of equity. Any users could go on the platform and decide to tokenize the equity. And as long as there's enough liquidity and volume to trade it, then all of a sudden you have a brand new financial asset that lives on the blockchain, but references the price of the real life equity stock price.
Got you. Okay. Graham, how does that differ, if at all, to what you guys are doing over at Polymath?
Yeah, so it's actually I would say kind of quite different. So at Polymath, what we do is we enable the creation and management of, it's called them new security tokens. So company wants to go raise $5 million. They could have a share certificate that they give to their investors, and they have them sign that, and people keep it in a filing cabinet somewhere. Or you could give your investors tokens that represent the interest in that asset. And so it's more the creation of new assets that we enable, and how to maintain regulatory compliance in the primary market, but also the secondary market through things like transfer restrictions. So ensuring that only the verified participants that are able to hold the asset can actually hold the asset and trade the asset. And then on top of that, things like buy lockup periods, sell lockup periods, jurisdictional compliance, volume transfer restrictions. So things of that nature, that's really what Polymath focuses on.
Okay. Well, when you say creating new assets, can you give us an example?
Yeah, so one of the largest tokenizations to date, if not the largest by a single entity, is a company called Swan, where I'm actually an advisor. So they're a commercial real estate marketplace. They have a number of asset owners, and now they've tokenized $2.5 billion of commercial real estate to date. So easiest example, asset owner has a $100 million property. They want to pull out $20 million of the equity. Well, they could try to find some real estate fund who wants to take down the $20 million, but that's going to take a few months. Due diligence is going to be even longer than that. The real estate fund is going to squeeze them on a bunch of covenants. They're going to make them do a bunch of things they might not want to do. And then the other option is go to a bank and get a loan. That would be a pretty high interest rate. So by contrast, what Swan says is, well, why don't we tokenize this $20 million of equity? Why don't we sell it to a pool of accredited investors where people can pitch in $1,000, $5,000, $10,000? So opening up the market to a number of different participants, where sort of the asset owner gets to make the rules now, and a pool of accredited investors can now invest in these types of assets.
So it sounds somewhat more like kind of crowdfunding in a certain sense.
I would say that's one thing that it opens up and it lends itself to really well, just because it's so much cheaper to now create these assets, and then also to manage these assets on an ongoing basis. Once you get all of the tools that you need on a blockchain, you really open up efficiency, automation, and transparency, which just brings the cost down so much that it makes it more technically and economically feasible to do those types of things with crowdfunding.
That's really interesting. Can we talk a little bit about the size of the market as it stands? I mean, how big is it at the moment, and what's the potential for growth, Josh?
Well, when we look at the market, this is the really exciting part, because it is essentially massive, right? So when we look at the crypto market, of course, there's different metrics to look at in terms of volume, user growth. But a very simple way to look at it is just in terms of the market cap of all the cryptos in the world today. And right now we're sitting around between 2 to 2.5 trillion in terms of market cap, total market cap for crypto. But when you look at the traditional market in terms of market cap, it is massive. So for equities in the world, we're talking about 100 trillion market cap of equities globally. And that's just one asset class. We can talk about bonds. Bonds, it's about 120 to 150 trillion US dollars in the world. And that's not including private real estate, like Graham mentioned. That's not including FX. So the potential to tap into this market it is just massive. And of course, we're sitting here because we believe that the future is about tokenization of these traditional assets. So if all that capital moves from the traditional asset base into the crypto asset base, it's very easy to see how tokenized assets on the blockchain could grow 50 times, 100 times. And referencing my earlier point in terms of talking about these are just only traditional assets, right? There's a lot of novel cases of tokenization like I mentioned before, Biology recently on Twitter, talked about hypothetically, what if, to tackle student loans or whatever, people started tokenizing their times and sell their times on the blockchain. I mean, that's such an interesting idea, and it could totally work too. And besides that, right, yesterday, I was just looking at Times Magazine, right? Time Magazine basically tokenized a bunch of the covers and then sold it as NFT. I mean, that's what NFTs are. It's a form of tokenization, right? And so now these Time Magazine covers are now sitting on the blockchain in a form of token, ready to be traded and monetized, right? So I think the market is massive, right? In terms of the quantifiable ones, it's about a couple $100 trillion already. In terms of the non-quantifiable ones, it's even bigger. That's why this is such an exciting space to talk about.
Yeah, I was going to touch on NFTs actually, because earlier when you were talking, I was thinking, well, that sounds an awful lot like NFTs. I mean, is there a difference between, securitized tokens, for example, and NFTs? Do we need to make that difference clear, or is it all kind of 6 of one, half a dozen of the other?
I mean, I think they could all fall under the general umbrella of tokenization, but obviously NFT is non-fungible, right? I mean, that's the point. Whereas a lot of the traditional asset classes are fungible. So one share of Apple is equal to another share of Apple. But if there's only one Time Magazine cover, then that's very unique and very rare, and that's essentially the value of NFTs. But if you ask me, they're all different forms of tokenization.
I mean, Graham, your marketplace is slightly differentiated. I mean, what is the state of play right now? What's the potential for growth? Where are you seeing your biggest kind of areas?
Yeah, so I mean, the market is still, I would call it relatively nascent compared to what it's going to be eventually. Just mentioned hundreds of trillions of dollars. We are not there yet, but I think it's going to be there at some point in time. The technology is just so much more superior than what we have today. There are so many financial securities still all around the world that are pieces of paper in a filing cabinet. Very hard to trade those things. People need to have handwritten signatures sometimes to authorize trades. If anybody thinks that's going to be taking place in 10 to 20 years from now, they're in for a very rude awakening. Everything is becoming digital. Securities are just one of the next things that are going to become digital. Bitcoin and a lot of these other cryptocurrencies now make currency 100% and inherently natively digital, rather than being just a proxy for a piece of paper, a dollar bill sitting somewhere. And so securities are just going through the exact same process right now, where securities are slowly becoming these pieces of paper that are becoming digitized, but now they're being created as a natively digital token. And so Josh mentioned Balaji. I also am a huge fan of his. And so he likes to talk about the transition between fax and email. So you go from sending someone a physical piece of paper in a letter, and then you go into sending them a sort of digital representation of that piece of paper, and then you go into the completely natively digital thing. And so we see that process happen over and over again in a ton of different industries, and we're seeing that with securities now. And so, yeah, hundreds of trillions of dollars, potentially quadrillions if you include derivatives, according to some metrics. And then the things that we haven't even thought about yet. How many more people start creating revenue share agreements for their tiny little store when you can do it with a click of a button? How many people start tokenizing their time? How many people start tokenizing pretty much all of the assets that they own when there can be a functioning secondary liquid market for these things? And so today I'm looking at securitytokenmarket.com, stomarket.com. There's $1 billion there. Red Swan's not there, but they're $2.5 billion. There are a few other things that aren't publicly traded, so they're not listed here. But yeah, let's call it a couple $1 billion. And we're going to hundreds of trillions of dollars over the next 5 to 10 years. So it's an incredibly exciting time to be there, sort of right before the hockey stick starts to take off. And so really, really excited for the next 5 years.
But then, of course, the fax analogy is interesting, because I remember my father saying, like, when the fax came in, everyone was convinced that the mail was going to be outdated, the phone was going to be out within like 5-10 years. It was all going to be over. And it turned out that wasn't the case. And then I remember when mini discs, because I'm old, came in, and we all thought, oh yeah, CDs are going to be replaced anytime now. But no one took MIDI discs up, but they did take MP3 players up that came along 5 years later, you know. So you're always, when you're so new onto the scene, you're always like, is this going to be the thing, or is this going to kind of open the door to the thing? Do you know what I mean?
Yeah, and I think, you know, people still use the mail, but it's mainly to order things from Amazon.
That's
You know,
true.
you're not communicating with anybody anymore using the mail, but you are buying tons of things, way more than anybody ever used to in the mail, because now I can sit in my house, especially when there's maybe quarantine restrictions or something like that. I can click a button on a piece of glass, and then my shampoo arrives in 24 hours. And so new technology always augments the existing market, and some players understand that and they get ahead of it, you know, FedEx, UPS, etc. And some people don't understand the change that's coming, and people still want to run a business model based on tech that's now 20 to 30 years outdated. And so new technology augments existing markets. It doesn't necessarily 100% replace and destroy all kind of legacy forms of that use.
Right. Let's kind of segue, in fact, into the technological area. You know, what challenges exist, specific kind of, perhaps not insurmountable, but really significant challenges exist in the technology at the moment? Josh?
I mean, I think technological challenges is a pretty big hurdle for tokenization, right? So, like I mentioned before, for our business, you know, we thought about going down two different routes. The first route is actually going and buying the real life paper of these stocks and then offering it to our users in a tokenized format. That was very complicated. So we went the second route, which was the on-chain tokenization of the stocks. But that presents another problem. The problem is that, you know, a blockchain kind of exists, you know, in a separate form, aside from the real world where the actual shares are being traded. And so then we have this problem of how to transfer the price of the actual shares onto the blockchain, and how to do it, you know, successfully and safely. Right now, if you look on the blockchain or any sort of platforms on chain, there is no price feed for a lot of stocks, a lot of equities. It just doesn't exist on the blockchain because, you know, previously there was no need for it. You know, you can find BTC price, you can find ETH price, but you're not going to find, say, you know, Tencent price or, you know, Toyota price. It just doesn't exist. So right now, to develop our product, we actually are in partnership with several large Oracle providers to, you know, to kind of figure out the way to do this safely through various APIs, various touch points, to make sure that we have a decentralized framework of feeding the price onto the blockchain. So, you know, these are some of the technical challenges, and, you know, we are definitely the first mover with our Oracle partners to trying to tackle this, right? And once we figure it out, well, we're very close to figuring out, then the product is actually going to be pretty unique and pretty interesting. So, I mean, let me just, you know, give an example of what could be very interesting recently. I'm sure, you know, you guys have all been, you know, watching the Evergrande situation unfold. Now, this is, you know, usually crypto world don't really care what's happening in the equity world, but this is a very unique situation where a equity company, equity stock and bond was driving the price action for a lot of crypto and crypto portfolios on the blockchain. So essentially, you know, what we could offer is a way to tokenize and create a exact same tokenized stock of Evergrande on our platform. And once that exists on the platform, then our users or users anywhere could use this as a way to go short the stock, as a way to hedge against market risk and market volatility. Or if you take another view and think that this is not a big deal, then you can go long the Evergrande tokenized stock. And you know that data doesn't exist on blockchain right now, but we're working with Oracle providers to actually feed that onto the blockchain. So you know these are some of the technical issues that you know we're working through right now.
And Graham, what sort of technical issues are you facing over on Polymath?
Yeah, so for us, the way we look at it, initially we built all of our technology on Ethereum. So we spearheaded ERC 1400, which is a backwards compatible security token standard with ERC 20. It's the most widely used standard in the world at this point. Consensus has their own implementation. The government of Norway has experimented with it. A top 10 bank is likely about to announce their ERC 1400 tokens they're creating about a month from now. But for us, we kept hearing the same issues over and over again when we started talking to especially large financial institutions. And we boiled it down to 5 things: governance, identity, confidentiality, compliance, and settlement. And I would say probably the biggest 3 are the governance. So just to touch on that a bit, it's mainly related to forks and how you can have forks on blockchains where you don't have a forkless architecture. So imagine if a bank has $100 million asset on a blockchain, and then there's the Ethereum Classic fork. Are there now 2 $100 million assets? Which tokens are the real tokens? Which tokens have the claim to the underlying asset? Does the issuer have to decide which chain they will follow? Does an exchange have to follow which chain they will follow? Do the users decide? Do you pick based on hash power? Do you pick 6 months from now and just pause trading until that sorts itself out? So forks on blockchains is a really big issue, especially when you talk to large financial institutions, because they don't want to have to deal with that uncertainty. The second one is identity. So on most of the blockchains today, there's no real concept of identity. Everything's pseudonymous. And you can build in sort of second layer solutions, and that's largely what Polymath did with the ERC 1400, is how can you have the assurance that only certain parties are able to transact with each other. However, it's not a very elegant solution. It's not very scalable, and it becomes very, very computationally expensive to implement a smart contract checking those things every single time a trade occurs. And then again, banks still don't really feel comfortable using a lot of blockchains. Some banks are slowly dipping their toes into things like Bitcoin, but when it comes to regulated financial assets, they're still quite uncomfortable using these things. So on Polymesh, every single user has to pass a KYC process. And then on top of that, all the node operators, so it's a proof of stake blockchain. So all the node operators that are validating blocks have to be regulated financial institutions. And then finally, settlement is a really big technical hurdle that we kept hearing over and over again from financial institutions, especially, where there is no concept of the buyer and seller affirming settlement instructions on most general purpose blockchains like Ethereum. So on Ethereum, if I find out your Ethereum address, I can send you any tokens I want anytime. You can't say, no, I don't want this one. And so I always get these things in my Etherscan notifications. Someone sent me some token I don't want, probably because they're trying to promote their website and things like that. And so when you tell Goldman Sachs or you tell another very large bank, hey, if someone finds out your Ethereum address, they can send you anything they want and you cannot say no. That's a really huge issue for them, because now they're going to have potential tax liabilities they don't want to deal with. When Visa announced they bought a CryptoPunk, I sent them some tokens, then they were holding poly tokens on their balance sheet. Like that's not something that they should have to deal with. And that was partly me showing, hey, this technology doesn't really work for the use case that you want to use it for. And then on top of that, just no one in the traditional financial world is comfortable with the concept that seller and buyer do not need to affirm settlement instructions. So on Polymesh, both parties need to affirm settlement instructions for any single token that gets sent between them. So just again, the reason why we aren't at the $100 trillion yet in terms of security tokens is because the banks aren't comfortable with it. And individual startups and a lot of these other smaller companies, these smaller broker dealers, et cetera, they can keep tokenizing assets, but I think to get to the $100 trillion mark, we need to get banks involved, and helping banks feel comfortable is a really big current technical hurdle that I think we're helping to overcome at Polymesh.
Yeah. So just to be clear, it's Polymesh, not Polymath. I've been saying it wrong.
No, so Polymath is a company that exists that created technology on Ethereum, but then launching soon is Polymesh. And so with that, technically the entity that's launching Polymesh is called the Polymesh Association, which is a member-based association in Switzerland.
Okay, good. All right, so both do exist.
Yes, both are real things. No, you're doing a good job.
I'm notorious for getting everything wrong with names, so it wouldn't be unusual. Josh, thank you so much for joining us again. I think you're having some Wi-Fi issues, so thank you for soldiering on. Are you there? Or have we lost him again? I think we've lost him again.
Yeah, technical issues.
We've got a bit of delay on the line, so I'll ask a question, you answer it, and let's see how we go. We've covered technical issues, so I'd be interested to hear your thoughts on regulation. Graham has touched on it a little bit, but certainly what you're doing has got to have lots of regulatory challenges. Can you talk to us a bit about that?
Yeah, sure. Would love to. So regulation is something that we pay a lot of close attention to, right? And I think, regulation for the entire crypto space and entire DeFi space is actually very unclear in terms of, what exactly is doable and what is not doable. There is no very clear cut rule of what is right and what is wrong. But the way that we look at it and we think about it is that, well, my personal view is that I think regulation needs to be updated, right? We are now in this world where people can send money, permissionlessly, within a second from end of the world to the end of the world. Therefore, regulations right now, what does it even mean, right? I mean, the way that we think about DeFi, we think about having a DEX is that it gives people more power and more, transparency, as well as more access to things that they need. So, for example, when we created this, we thought about, not for people in the developed nations, like U.S. or Hong Kong, where people have a lot of access to financial instruments, but we thought about places like Argentina, places like Vietnam, places like Turkey, where people have very limited access to interesting investment targets globally. In fact, some of our most engaging users are from Vietnam and from Turkey, because they do want to buy stocks and buy equities globally, but they just cannot do it because their government have this capital control on top of them. But once they convert their money into crypto, then it becomes permissionless. So if we think about this, right, is this a bad thing or is this a good thing, right? From my personal perspective, I mean, I believe that this is a very good thing. Therefore, from a regulatory perspective, then how do you actually tackle this, right? Because for some of these countries, there is a reason why there is capital control. But with that being said, right now we're just too small of a fish to be kind of like noticed by any sort of these regulators. But going forward, we would love to talk to regulators, sit down with regulators, and think about how to tackle this asset class, because this is coming, right? We talked about hundreds of trillions of dollars of assets. Things are becoming digital, right? Like, we're writing emails, we're no longer writing letters. Everything we do is digital. Asset ownership will become extremely digital in the future. So this is coming. Tokenization is coming. In terms of how will people do it in a regulatory, conformed way, then that's something that we want to explore. And recently, Gensler, SEC, right? They talked about regulations, and what he mentioned about decentralized finance. What he mentioned about DeFi is that he wishes DeFi companies to come in, like that was his word, to come in, and then they could kind of figure out a way to solve it. So from the regulator perspective, you can kind of see that they don't really know either, but it is going to be sort of a partnership going forward to see how we can kind of all solve this. Yeah, so I mean, I'm very optimistic to think that we will find a solution, but as of right now, I think there's a lot of things to work out from a regulatory perspective in terms of crypto in general. To be frank.
Right. Sometimes it feels like a bit of a Mexican standoff. It's sort of we're all kind of waiting, like, okay, you're gonna move, or are we gonna move, or how are we gonna work this out, guys? But yeah, I think we're gonna get there in the end. Well, listen, we're running towards the very end, so I want to give you guys a chance to kind of plug what you've got going on, talk about what's happening with your projects coming up. So Graham, do you want to go first?
Sure. Yeah. So we had some big announcements this week at Monday at the Masari Mainnet conference. So we announced a go live date, a scheduled go live date for the Polymesh blockchain. So I mentioned some of the issues that we've seen around putting regulated assets on blockchains, especially general purpose blockchains like Ethereum. And so we started building our own blockchain purpose built for security tokens back in May of 2019 is when we announced that. And so finally going live with mainnet, which we're all very, very excited about at Polymath. And so some of the key things there, where I talked about governance, identity, compliance, confidentiality of assets, and then also settlements. So how can you get banks comfortable with this asset class so we can take it from the couple billion that it's at today to the hundreds of trillions that we all want to see in the next 5 to 10 years. And so Polymesh going live October 13th is the scheduled date. So everyone check your calendars. If you want to find out more about Polymath and all things Polymesh, you can go to polymath.network. We have a lot of resources there, tons of videos, tons of explainers to get you up to date on all things security tokens.
Perfect. We'll make sure that we put a link to Polymath as well in the description box for anybody that missed that. Josh, what can you tell us about NASDEX? What's happening?
Sure. So we're actually just in the middle of, coming to our IDO. Our IDO is going to be on the 28th. So next week, very soon. And, you can basically, right now the whitelist is open. So if people are interested, they could, take a look. You can find our website at nasdex.xyz. That's NASDEX. You can find us all on Twitter as well, using the same handle, NASDEX_XYZ, and you'll find all the details in there. And that's pretty much it. But I just want to say that the money is coming. There's going to be a lot of capital flowing into this space. It doesn't have to even be with NASDAQ or anything else. I mean, the future of traditional finance capital moving to crypto and DeFi, it's pretty much a set trend. One thing I want to mention is like Coinbase, right? I mean, I find this very interesting. Coinbase just raised $2 billion in terms of debt from very traditional asset managers. The debt offering was oversubscribed. People wanted to have 7 billion. Eventually they said, no, we can only do 2 billion. And Coinbase is paying 3.5% on borrowing this $2 billion capital. And guess what they're going to do? They're going to put it in crypto, and they're going to buy crypto, and that's, that's going to yield like, 20, 30%. So, I mean, the trend is there. The flow of capital from traditional markets, traditional assets into crypto markets, and DeFi and tokenized, equities, tokenized assets, it's there. So, it's a very, very exciting time to be working in this space.
As long as the SEC don't sue you out of your lending practice, I guess. Fine. We love the SEC.
That's right.
Hi, guys. Anyway, that's as much time as we've got, guys. It's been so interesting. This is an area I don't personally know much about, so it's been really, really interesting. I'm going to follow your projects with interest. Everybody, you can follow us at Yield App on your social media handle of choice, except TikTok. We're trying to convince Tim to do TikTok videos. We're getting there slowly but surely. Oh gosh, there's my studio light down on the floor now. Anyway, thanks very much for joining us, and we will see you next time on Fridays with Yield App. I've been Rebecca Jones. Say goodbye, Josh.
Bye, everyone. Thank you.
And Graham.
Bye. Thanks, everybody.
Thanks, everyone. Take care and see you next time.